Yeah, right, Ajay. So it's always a good discipline for investors to allocate larger monies in market dips. So, from that perspective, it is interesting, and we've seen a long-term trend in terms of domestic savers allocating more towards the local domestic equity markets. That's something that is encouraging.
Mrinal, we were just talking to Chris Wood of Jefferies, and telling his strategy note is something which we all read every now and then, the greed and fear, and he was saying that attractive valuation in the market only will be for indicative purposes, Nifty coming down to 14,000 levels. What are your own numbers saying about valuations right
So,
now?
very, very interesting question, Ajay. I think the index levels are a weighted average of a whole lot of stocks, Nifty being 50, Sensex being 30, then there is BSE 500, the most broad rate index. But then within that canvas, we see there are some sectors and stocks which have corrected meaningfully, and there are some which have actually done well. So there is a clear transitioning happening, what I would call in how investors perceive the growth outlook for a lot of businesses. That includes sectors as well. Be it banking, we have seen some change of hands. In particular, within banking and financials, we've seen energy finding and utilities finding focus in customers. So although the broader analysis of the markets, but given the perspective that you might take, what typically historically the bottom has been, could throw up a number, 14,000, 15,000 or number like that. But then it also needs to be kept in mind that there are businesses which in a way are in terms of valuation reflecting that or are close to that, and also there are businesses on the contrary which might be reflecting a 18,000 kind of Nifty as well, if I have to just use that as a benchmark. So it basically boils down to how do individual investors look at the fortunes of the cash flows or businesses and profits for individual businesses in particular, and sometimes the overlay from the sector is meaningful. Like I would say, energy and utilities is a very much sectoral overlay. To some degree, commodities might as well be, ferrous, non-ferrous, and coal separately. And then there are consumption-oriented businesses and so on and so forth.
Mrinal, have you started loading up on commodity user industries, which were under pressure, margin pressure for a long time, say capital goods, select autos, all of those, on anticipation that commodities may have peaked? Because barring crude, in totality, agri, non-agri, all commodity prices have come down 15-20% from their recent highs.
So, well, that's right. In fact, that has been finding favor in our allocation for last 1.5 months or so. In fact, the margins for across the board businesses, but for services exports businesses, have been under pressure because of input costs. So the markets globally, and India is no exception, are worried. The overarching concern has been inflation. Even the yesterday's MPC talked about an inflation outlook driven by food in terms of their forecast to 6.7% for the coming year. So, and one of the things that it shows up on earnings is on the margin side. So I think market is somewhere in the middle of where they think the inflation expectation could settle, and nobody is talking about, nor the market participants, of inflation having, is something that is going to go away in a quarter or two. So the margin as well as profit expectations, are kind of, on the tenterhooks for a lot of investors, which means that there are some interesting prices that we began to see, particularly in the consumer of these rising input costs, particularly the non-crude commodities, even crude commodities for that matter. Some of them have overreacted, which might be of interest, particularly specialty chemicals. They possess interesting ability to pass on prices and things like those. So yes, you're right. From a medium-term perspective, from a long-term perspective, the consumers of those commodities, we've gradually started picking up. But that's not to say that inflation concerns are behind. No, I wouldn't say that. In fact, inflation is the most overarching theme for every investor globally, including ourselves in India.
What's troubling pharma, and how are you approaching pharma? I was just looking at the BSE Pharma Index. It's some 12-15 month low. And if you take a list of top 10 stocks which form, say, 80-90% in market capitalization, barring a, say, Sun Pharma or DRL, I'm just taking just a name for explanatory purposes. So every large cap company has some issue or the other. How do you see this space, pharma, on pricing pressures and US growth and all of that?
So healthcare, we generally bucket healthcare into 2-3 things. Over last 5-10 years, it has evolved from it being only pharma or let's say branded generics. It has now diagnostics, it has hospitals. We as well have API manufacturers. I think API manufacturers in particular have taken the brunt of supply chain related disruption plus input cost rising. They weren't largely able to pass on that, and that impacted their margins and their valuations and stock prices meaningfully. Wherein they are also beneficiary of schemes like PLI. The outlook for their volumes and their capex is very robust. I think one of the best places to invest within healthcare is API manufacturing, because let's say in a couple of years, we'll see volumes moving up. Currently, their P&Ls look compressed because of input costs. And when things do normalize, there would not only be normalization of margins as well, but volumes. So we are very, very optimistic on healthcare as a space. We think that's an area where households will incrementally spend more money. That has been the trend, like we've seen every geography or every economy which has transitioned from a $2,000 per capita to $3,000 per capita. So, and within healthcare, API finds favors for our investments, API manufacturing. We do like domestic-oriented formulation businesses as well. And we are choosy about which kind of hospital or diagnostic stocks we would like to evaluate. But overall, as a space, we find that a very promising and a very good runway of potential returns that our investors can make from those investments.
Right. Mrinal, coming back a bit on markets, it has been almost a 10-month stretch of correction, which started in October, and then factor after factor, negative crude oil and disruption in logistics, war, all of that started playing out. It has been a pretty decent stretch of corrective phase. No one can really time the market for sure, but do you see earnings growth continue next 3 to 5 years in a very healthy manner, which may actually start taking more center stage going forward? Or do you think we may remain in this kind of a corrective phase for long?
Well, interestingly, the near-term concerns from the deteriorating geopolitics globally, energy prices being elevated, inflation being more than transient, I think they might, put some concern around the earning outlook, which in our assessment is still for FY23, at least on the larger index, which is Nifty, which we still think will be anything up in 12 to 15%. It might moderate if things deteriorate, but then it doesn't take away the benefit that at least the 3-year trajectory for a lot of businesses, which in our view are capex oriented, particularly on the manufacturing side, the outlook for earnings for them is very, very robust. In fact, it improves once they walk out of that capex, because the demand as of now is so strong due to increasing market share that India is seeing in the global supply chain landscape, that currently the kind of investments and capacity expansions that we are seeing will start yielding benefits in the P&L, let's say 2 years or 3 years down the lane, and that will show up in their profits and in their valuations. So, in fact, the sheer data of capital good import itself has been so strong, which gives credence that the manufacturing part of economy at least in our country, is showing very good signs of growth, and it will drive the further growth from here on, is what I feel.
In fact, that was quite visible in RBI governor's commentary as well, when he spoke about how the domestic economy is doing on manufacturing, rural front. Both of them, the commentary internally pretty okay. Before I let you go, a quick thought on the small cap, mid cap end of the basket. Has that started to get attractive now after correction, or only select pockets would interest you? Overall, this universe is still not very attractive.
So it's a very large universe. Frankly, more than 2,000, 3,000 stock in mid and small cap combined. The definition of mid is restricted to 100, 150 stocks. But then as a combined space, small cap is the largest space. So you can never have a broader blanket view. But then at least in the pockets of interest to us, a decent attractive valuations in some select names are emerging. And we are finding, as things proceed, there could be more clarity on how the business outlook could pan out for a lot of these businesses. So, but generally, they also take the brunt of institutional or market-wide selling. So we have to be a bit more experienced and nuanced about how we accumulate those names and businesses. There has to be a lot more work done around the management quality and a host of other things. So these things keep us busy in terms of small and mid cap in particular. But then that's the focus of our energy and time. As of now, we believe that the significant long-term returns will emerge from that space. And this is a year where we would like to pick up select names that will make a meaningful impact on the portfolios, particularly in small and mid cap side.
Clearly, those, we sometimes, or most of us actually, among the investing universe, people forget that equity returns, they appear on a CAGR, kind of a manner seen on a Excel sheet, but actually they are delivered in a lumpy manner. So there are years of accumulation, and then there are years of enjoying the return. So perhaps 22-23 continues to remain the year of accumulation, while we enjoy the fruits of this in 24-25. Thanks very much, Mrinal. Always enjoy our chat. We'll chat up once again.
Thank you.